Hi, and welcome to our NatWest Markets podcast. I'm Michelle Girard, Chief U.S. Economist, and here with me is Giovanni Zanni, who covers the Euro area, and Ross Walker, a Chief UK Economist. So we're talking about the global economy and the fallout of the coronavirus. We've all been looking at the numbers. I think the thing we've been focused on is the fact that we're starting to move from what perhaps are supply side disruptions to production and activity associated with the coronavirus, to perhaps the risk that it presents to consumer demand and consumer spending. And a lot of that concern obviously came following what happened in Italy. So Giovanni, maybe you should start us off by talking about what's happened in Italy and your thinking in general about some of the impacts on the Euro area from coronavirus.
Sure. Thanks, Michelle. Well, yes, I mean, what was happening in Europe is quite interesting because until a few days ago, really, the data that we had on Q1 activity were pretty benign and actually showing that activity was rebounding, that the supply fears that were mentioned appear to some extent in some of the data, but were generally very mild. And the overwhelming message was that activity was recovering, that we had some issues related to actually exports, so a demand side factor to China and to Asia. But overall, the kind of recovery of the economy was the most significant element of the story, and we were happy with this idea of Europe that was going to have a good year also because of positive policies, fiscal policy supporting that, and disposable income also in good shape, consumer confidence was supported.
And then came the coronavirus.
Exactly. And things have changed quite dramatically in Italy over the past few days. And I think this has implication for Europe more generally, and also maybe for other areas that will be affected by that, but you will discuss that later. What I would say is that for me, what's happening now in Italy is that the government, to react to the increasing number of cases, has started to put in place measures that are quite limitative in terms of economic activity. But the biggest implication is that there is fear in the population, and so they've started to reduce activities, going to the movies, going to restaurants, stopping travels. A lot of flights, from Milan to a lot of other places are quite empty right now, and have been even stopped. So there's a lot of really, demand-driven implication to activity that are there and are going to stay at least for a few weeks or a few months at least. So when looking at this situation, at these shocks, we know that most of times it's V-shaped in nature, but it's also the case that we are just entering the negative phase of that. And so I would say if I had to revise my forecast, I will definitely talking about very subdued growth, if any, in the first part of the year, and then with some recover and compensation for that in the second part of the year.
So, Ross, you and I in the U.S. and the UK have not yet seen the widespread outbreaks that, like we've seen obviously in Italy, although that's our concern. What do you think the risks are in terms of how things might unfold for the UK?
Yes, to date, the UK surveys have been improving, partly because at the tail end of last year with Brexit risks, business confidence in particular was being weighed down. Less so the consumer. The consumer in the UK has been relatively resilient, some would say indifferent to some of these wider political risks. But I think, as Giovanni was saying, in the Euro area Italian context, the big question is whether we see a material and lasting effect on consumer behaviour in response to the coronavirus outbreak. And thus far, the numbers in the UK in terms of registered infections and so on is minuscule. But it feels like, as we saw this week with the issue emerging significantly in Italy, that the UK will be seeing something similar. And we have an economy which obviously has a large consumer leisure services sector. We have a lot of transportation issues and potential disruption. And seasonally, I mean, if healthcare problems exist, we are still in winter, late winter, but seasonally high pressures on the healthcare sector. So we could see a material impact on consumer sentiment. In terms of the first quarter UK GDP numbers, we were looking for fairly modest growth anyway, plus 0.2% quarter on quarter. We haven't yet revised that. There are obvious downside risks. I think we maybe see a bigger direct impact in the second quarter. But one issue for the UK will be, as we move into Q2, we see the start of a meaningful fiscal uplift. So the data, I think, is certainly going to get noisier. Obvious downside risks, but at the moment, we're still really waiting for some evidence, even in the surveys, of the economic impact of this.
So, exactly similar to what you said, Ross, about the UK, the same sort of thing in the US with respect to the consumer being a relative bright spot for our economy, offsetting weakness in manufacturing. That had been the theme, and that's where the coronavirus does present risks if we're worried about the psychology of consumers being affected. And as you said, Giovanni, it becomes a fear, kind of driven change in behavior, whether it's rational or not. If people begin to, exactly as you say, not go to restaurants, not go to sporting events, look to reduce travel, there will be obviously a hit to consumer spending at a time when other parts of the U.S. economy, namely the business sector, are already weak. And depending on how extreme the pullback is as the virus and contagion, unfolds, you could see, you can't rule anything out. I mean, you could have a situation where you start to worry about, even in the U.S., negative GDP quarter. We ourselves did not come into the year with as much optimism as certainly you had, Giovanni, about the euro area, because one of the other factors that I think is providing a headwind for the U.S. over and above the coronavirus is, of course, the U.S. election and the uncertainty around the election and a candidate, emerging on the Democratic side that could be very challenging for business. And we had felt that was going to create a headwind for the business sector anyway and introduce uncertainty that could perhaps be unnerving for markets. And one of the points is a question that's often raised is, to what extent does this weakness in the U.S. equity market reflect coronavirus concerns, or versus the concerns that you could have a president like or a candidate rather like Bernie Sanders on the Democratic ticket, who has policies that businesses I think would be concerned about. So we've got things in the U.S. that even if the coronavirus sort of started to stabilize, our pickup in growth might lag a little bit behind what you see in the euro area or in the UK, because we've got the presidential election and uncertainty around that might continue to keep, on the business side, cautious activity until we get into the fall. So I'm watchful in the near term about the impact on the consumer, which could be very destabilizing for the U.S. economy. But then a longer lasting concern continues to be uncertainty around the election. I think it all then comes back around to, we've got near-term growth concerns. How concerned are policymakers, and what might the response be from central banks or fiscal policymakers to the damaging impact of the coronavirus? So how about for you, Giovanni? Where do you see the ECB stepping in to do anything, or will fiscal policy need to be more active?
Yes, that's a very good question, I think, because if you look at the European situation specifically, you might say that the ECB should do something soon, and the market is starting to price some of that. But it's true that they are, and I think rightly so, putting any rate cuts towards actually the end of the year, not like an immediate reaction to the coronavirus. First of all, because that's what the ECB officials have said, and also it makes, I think, a lot of sense given that the negative rates are already quite controversial. There's a lot of talk about the negative side effects of this policy, and the ECB has already clearly stated that it's fiscal policy that should move in that direction, and they've reaffirmed that over the past few days. There are signs that in Germany things are moving. There are discussion about changing the debt brake, but also using some of the rainy funds that they have already in place. There is already in the pipeline a fiscal policy that is more expansionary for this year. At the European level, there have been declarations that they were ready to use further measure if downside risk appear. So there is a kind of body of evidence, I would say, that is pushing towards what we had already anticipated in a sense, and the case for that is even clearer. So it's not so much a story for the ECB, I think. It's definitely a story for fiscal policy being used and being used more in a more aggressive way in the coming months. From the small measure that can happen to ease pressure on companies in Italy in the specific sectors affected and specific areas affected, to something like more macro economic at the national or even European level. So I would say this is not a change from a forecast instead of the GDP numbers, but I think it's an accentuation, a more clear view that we'll have there, that fiscal policy will be a key story for Europe.
Driving. How about in the UK, Ross, with the BOE rate cuts, or in response to any economic threats?
Well, I think the UK story is similar to the euro area one that Giovanni outlined. So in the coming months, fiscal action will be more prominent than monetary action because we have a budget on the 11th of March. Although there are some media reports that there may be a delay to some announcements, the bulk of the extra spending, public spending that's coming in the coming financial year was announced back in September. So there's been plenty of time to plan for that implementation. So we think the fiscal uplift this year will be about £18 billion, 0.8% of GDP. That's firstly a significant turnaround after pretty much a decade of fiscal tightening. So the fiscal lever is being pulled, and will have a material impact on growth this year. So I think that's one reason why the BOE may be less preemptive. And secondly, although we've seen sizable moves in financial markets, and that will be significant for the Bank of England, they will view this as a tightening of financial conditions. I think we probably need to see clearer evidence in the economic data, and probably not just the surveys, some of the hard data as well, and for the BOE to believe that there is a more lasting impact. And I think it's quite reasonable to conclude now that there are clear downside risks, and that those downside risks are sufficient to warrant some near-term monetary policy loosening, some interest rate cuts, say, at the next quarterly forecast round in May. That still feels quite early to me for this Bank of England, which has been resisting the idea that significant monetary loosening is required. So I think for now, the Bank of England's tone will get more cautious. They will clearly be acknowledging the downside risks, but they do have some fiscal action. I think that buys them a little bit of time. But on balance, we are almost certainly going to have to revise down our UK GDP forecast this year from, say, 1.2% at the moment, probably to around 1, maybe a little bit below 1. For me, that's clearly below trend, even with the fiscal boost. And so, this increases the likelihood of rate cuts. I would caution against assuming we get one very quickly. We might have to wait until the second half of the year.
Where I think it's similar in the U.S., where there actually is a little bit more scope versus the ECB and even the BOE to cut rates, given that there is more room, but. The Fed themselves coming into the year had set a relatively high threshold for further rate cuts, using the term material reassessment. A material reassessment of the outlook would be, required to precipitate further action in terms of lowering rates. Now, this is what the question will be: does the coronavirus, if it leads to particularly a weaker consumer, and the growth numbers do fall far short and look like they're going to for a longer period of time than the Fed is comfortable, stay lower than what would have been anticipated, does that meet the threshold? And I similar, I think, to what you're saying about the Bank of England. I think their tone will get more cautious. I think the Fed will acknowledge that they're watching the circumstance, and will express even a willingness to take action if necessary, but will indicate, as they have to date, that they want to see how persistent, the magnitude and the persistence of the economic impact. So I don't think there is a sense of near-term action. The market is pricing in 3 cuts this year. It's run ahead of, I think, probably where the Fed right now would be comfortable. They're sort of assuming another round of insurance cuts. I think, as I said, certainly action as soon as March seems unlikely, even with the sharp fall that we've seen in equity markets and the tightening of financial conditions. I do think that they will want to wait, as similar as you said, Ross, for tangible evidence of the impact in the hard data to be able to get their arms around what the degree of impact is, and to have a better sense of whether this is a short-term, V-type hit, which perhaps is best for the Fed to just wait out, or if it will require action to shore up psychology or to stabilize markets. And that's the question. But I come away with the same feeling that the action may be more delayed than some in the markets may be anticipating, even with the moves that we've seen in financial conditions.
Yeah, and I think that's a very interesting point also, taking what Ross was saying and what the chief economist of the ECB said as well. So even in the European case, where things are probably a bit more difficult right now in terms of the economy, the ECB seems prepared to wait, actually, because it's probably a V-shaped nature, because of having the actions, especially on interest rates, having a more kind of lasting, persistent effect, and so reacting only to a material or persistent change that is assessed through time. So I think that
one of the features of the UK consumer data is that UK consumers individually, when asked about their own financial prospects, have been way more optimistic than when asked about the wider economy. So there's a perception that somebody else may have a problem, but I'm all right, Jack. And so I think, firstly, until and unless we see a more significant deterioration in how consumers perceive their own financial prospects, you may not get a bigger change in behaviour. So forecasting this is not entirely straightforward. And also, up to now, or for the last few years, certainly in a UK context, the downside risks have been centred very much on the corporate sector and the capex cycle. And in many ways, although it's a very cyclical indicator, business investment spending, there was at least a clear sense in terms of the direction of risks and maybe the magnitude of any slowdown. As I say, the consumer feels a little bit more nuanced. To me, and from a sort of forecasting perspective, as I say, whether consumers firstly get more pessimistic about their own prospects and the extent to which that changes their behaviour. But again, to me, it's another reason why, until we have a slightly clearer handle on that and a little bit more data, policymakers, may use that as a reason not to be overly preemptive and not to be seen to overreact. Equally, it's a fine balance. If you then are perceived to be missing the bigger trend here and getting behind the curve, that could be self-defeating, certainly from a market's perspective. So it feels very fluid.
Well, the other thing I'll just kind of round out in the U.S. that it also feeds into our policymakers' response. A question I get often is, to what extent does the election play into the Fed's willingness or lack of to lower interest rates? Will it be, if the Fed does cut rates, will it be seen or interpreted as a sign that the Fed is is politicized, that they're doing so to sort of stabilize the economy and the markets ahead of the election. And I think the Fed will make its decisions independently based on what it feels is happening with the economy. But on the margin, that is a factor. People have rightfully, I think, assumed the Fed would, all else equal, prefer to sit out this year in terms of taking any action, so as not to in any way be drawn into the political discussion. And that is another element in the U.S. that I think people expect may feed into their own natural desire to be more patient in terms of rushing to provide economic support through lower rates. So,
well, I think that concludes this podcast. Please do continue to follow us on social media and via our website. Thank you for listening.
Thanks.
Thank you.